Lucid Group Inc. is trading right now at 6.56 per share during the early pre-market session on Monday, June 1st, 2026, marking an intraday upward movement of 1.55% from its last closing mark. While the initial reaction to a green morning might cause everyday retail investors to breathe a sigh of relief, the underlying mechanical reality of this equity tells a far different story. Just this morning, Silvio Napoli officially assumed the role of Chief Executive Officer, taking the reins of a company that has seen its equity value eroded by roughly 45% since the start of the year. The broader expectation from mainstream financial headlines is that this leadership transition, coupled with a massive multi-billion-dollar robotaxi partnership extension with Uber, creates an open runway for a rapid stock recovery. The expectation is that a fresh operational mind can instantly solve the supply bottlenecks and financial bleeding. The reality, however, is that Lucid is currently caught in a structural trap of massive cash consumption, dilutive capital raises, and a complete suspension of its full-year vehicle production guidance that forces institutional desks to recalibrate their risk models entirely. When you scan public forums or simple trading boards, the consensus surrounding Lucid often treats the company as an existential bet on luxury engineering. The common narrative says that because Lucid builds vehicles with arguably the best battery efficiency and longest range in the world, the equity must eventually appreciate to match the superior hardware. This expectation is exactly what keeps retail buyers loading up on fractional shares on simple online investing sites. But when you move past that surface-level belief and dissect the actual structural mechanics of the trading volume, a stark contrast emerges. In its first quarter earnings report, Lucid posted a massive revenue miss, bringing in $282.5 million against analyst expectations that stretched as high as $449 million. Worse still, their net loss widened to a staggering $1 billion for a single quarter, up from $366 million in the same period last year. That means the business lost more than 3 times what it generated in total sales during the quarter. When professional funds manage an individual brokerage portfolio or look for self-investing options through sophisticated tools like interactive brokers, they do not just trade on the elegance of a vehicle, they trade on the math of the balance sheet. Let's look closely at the immediate price action and trading volume that led to this current 6.56 level. Throughout April and May, the equity faced severe structural selling pressure, sliding from the 10 range down to a low of 5.55 before finding this minor consolidation floor. The driving force behind this drop wasn't just a general market sell-off, it was a massive structural shift in ownership and dilution. On April 14th, Lucid announced a massive capital raise of approximately $1.05 billion. This included $550 million in convertible preferred stock issued to an affiliate of Saudi Arabia's Public Investment Fund, alongside $300 million from a public common stock offering and $200 million direct equity injection from Uber. While this capital raise effectively pumped their total pro forma liquidity to a healthier $4.7 billion, preventing an immediate cash crunch, it did so at a tremendous cost to current equity holders. Every time new common stock is issued to shore up a bruised balance sheet, the existing ownership slice of every single retail trader gets diluted. For investors managing their portfolios on standard investing sites, this structural dilution acts as a persistent ceiling on any upward momentum. This brings us to the operational dislocation that shook institutional confidence over the past few weeks. In the first quarter, Lucid manufactured 5,500 vehicles, but managed to deliver only 3,103 units. A significant portion of this gap was caused by a 29-day production pause in February for the Lucid Gravity, triggered by a supplier quality defect regarding volume, and deliveries meant that millions of dollars in capital became trapped in unsold inventory sitting on asphalt lots. When inventory builds up, cash flow turns negative, which is exactly why the company reported a non-GAAP loss of $2.82 per share, missing the consensus target by a wide margin. In response, the incoming executive leadership team took the drastic step of completely suspending their previously stated full-year guidance of 25,000 to 27,000 vehicles. For a high-growth electric car manufacturer, pulling your annual production targets is the ultimate warning sign for Wall Street desks. Without concrete guidance, institutional analysts cannot accurately model future cash flows, leading to a cascade of price target downgrades across major institutional trading desks. When comparing this specific asset to the broader market, look at how the expectation of a rising tide lifting all ships has failed to materialize here. While the broader indices have shown resilient single-digit gains throughout the first half of the year, Lucid has been highly decoupled from general market strength, showing a weak correlation with the index. Instead, it has been driven entirely by its idiosyncratic balance sheet pressures and micro-level execution failures. Large asset managers who allocate capital across major exchange-traded funds, such as various Fidelity investment products, Fidelity ETFs, or Fidelity mutual funds, typically mandate strict capital preservation rules.
When a company showcases a structural loss of this magnitude, it routinely gets filtered out of high-quality individual brokerage accounts and automated premium wealth strategies like Schwab Intelligent Portfolios. Instead, the stock becomes a vehicle for heavy short-selling activity and high-frequency intraday speculation on fast-moving apps like Robinhood. Comment below how many shares of Lucid Group Inc. you currently hold in your account, and let me know if you are actively buying this dip or looking for an exit. To truly understand why the stock is oscillating at this 6.56 mark, we have to look back at the historical framework that brought the company to this crossroads. Lucid originally entered the public markets with an immense premium narrative, positioning itself as the definitive corporate challenger to Tesla stock. The market bought into this narrative heavily, pushing the valuation to astronomical highs based on the engineering pedigree of its leadership. The business model was built on low-volume, high-margin, ultra-luxury sedans, with the expectation that the premium pricing would generate early structural profitability to fund their mass-market platforms. In reality, the scaling costs of automotive manufacturing proved to be far more capital-intensive than early investor decks suggested. To cope with the cash drain, the company had to execute a significant 1-for-10 reverse stock split in August of 2025 just to artificially boost its per-share price and maintain standard exchange listing compliance. Looking at the long-term trend, the company's enterprise value has systematically contracted from over $11 billion down to under $5 billion, even as total trailing revenues managed to crawl upward to $1.4 billion. This compression highlights a savage re-rating of the company's price-to-sales multiple, which collapsed from an aggressive premium down to a modest multiple of just 1.4 times sales. This sharp multiple contraction reflects a fundamental change in how the market values electric vehicle startups. A few years ago, access to cheap capital meant that growth projections were valued far above actual current earnings. In the current macroeconomic landscape of persistent capital costs and tightening corporate credit, the market requires path to profitability clarity. Lucid's business model is now completely reliant on external sovereign backstop funding to survive its current development loop. The corporate relationship with Saudi Arabia's public investment fund is the only structural anchor keeping the company capitalized. While having a sovereign wealth fund with near limitless capital as your primary majority shareholder provides an unmatched safety net against immediate insolvency, it also alters the corporate governance dynamics. The public investment fund holds substantial convertible debt and preferred tranches that sit senior to common equity holders. If the business requires another multi-billion-dollar cash injection next year to launch its mid-size vehicle platform, common shareholders will likely face another round of structural dilution. Looking ahead into the remainder of the year, the performance of the equity will be dictated by two conflicting forces that define our core theme of expectation versus reality. On one hand, the bullish narrative focuses heavily on the expanded corporate partnership with Uber. The commitment to integrate at least 35,000 Lucid vehicles in Uber's global autonomous ride-hailing network over the coming years gives Lucid a guaranteed long-term commercial buyer. If the company can successfully scale deliveries of its Gravity SUV and hit the technical milestones for Uber's robotaxi alpha program, it could unlock a highly predictable, high-margin business vertical. This is the exact type of catalyst that growth investors watch for when optimizing their self-investing setups on advanced interactive brokers trading platforms. The bearish reality conversely focuses on the structural reality that the core consumer luxury segment is facing a significant demand slowdown. High-end buyers are holding on to vehicles longer, and competitive price reductions across the global premium market are eroding gross margins across the board. For individual traders navigating these volatile movements through standard online investing tools or the interactive brokers platform, managing this asset requires an absolute separation of product admiration from financial analysis. The engineering excellence of the vehicle platform is real, but the near-term structural risk on the common stock is equally real. If the new leadership under Silvio Napoli can present a highly transparent, realistic production roadmap during the upcoming second quarter earnings call, the stock could easily trigger a massive short squeeze, lifting it back toward key moving averages. However, if the updated guidance reveals deeper supply chain friction or points toward a further delay in scaling the high-volume mid-size vehicle line, the current 6.56 support level could easily give way to new lows. Ultimately, this equity remains a battleground where the short-term reality of severe balance sheet strain continues to clash directly with the long-term expectation of global technology adoption. When you summarize the core structural mechanics governing Lucid today, the contrast between market narrative and financial reality becomes undeniable. The market desperately wants to price in a bottom based on the premium executive transition and the multi-thousand vehicle Uber robotaxi deal. Yet the hard data on the balance sheet shows a company that is structurally diluting its common shares to cover a billion-dollar quarterly burn rate, while flying blind without clear annual production guidance. For long-term portfolios focused on structural wealth preservation across major brokerage networks, this asset demands a highly disciplined approach to risk sizing. The premium engineering assets and sovereign wealth backing ensure that the company will likely continue operating, but until the underlying manufacturing math turns cash flow positive, the common equity will remain a highly speculative vehicle defined by high volatility and persistent execution risks.